A minute ago, you were talking about AI and how it's impacting academics, and I was curious if you see it at all in the corporate world.
It's there. I mean, I don't think there's a major corporation of any size that isn't using or thinking about how they can use it. I mean, and large language models are just one aspect that the general population is familiar with because we can use it on our Google search and other things. But the ability to train AI to do basic level corporate activities, a perfect example. There's AI software that's been created that will write an analyst report on a particular company, doing the things that a first year analyst hired on a Wall Street firm would take a day or two to do. You got to get the company, you got to get their financials, you got to calculate the ratios, then you got to go get 3 or 4 similar companies, create the ratios, average them together, you got the comps. So then you start saying, well, how does this company we're examining compare to its closest competition? And then you write a summary of what all that means. That would often take an analyst a day or two at the minimum to do that. Now there's AI software that can do that in 5 minutes. So, I get kind of worried that a lot of the entry-level positions that graduates, whether they're college graduates or even the students who come out with an undergraduate/master's degree, taking essentially their first job, entry-level position, in certain fields, some of these entry-level positions are going to start disappearing very quickly because it's way cheaper to use AI to do this than it is to hire an analyst at $60,000 or $80,000 a year. So it's there, and it's only going to get better. It's going to move into accounting because at the end of the day, accounting is a very rules-based activity. These are the things that you can teach AI to do very quickly. So what are accounting majors going to do for entry-level positions if an AI software can do what you would have done for 1/100th of the cost? So but it creates more existential questions, because if you don't have entry-level workers at some point, how do you in 5 years have mid-level people, or 15 years have senior people? So I don't know how. I mean, I don't think it's going to be an all or nothing, but it is going to, on the margin, change things, and it's going to affect what colleges have to prepare students to do. And it's going to be less about doing something that's defined and tangible, because AI, that's exactly what AI is good at doing. It's going to be more about dealing with, we have a problem here, how do we think we should address it, and what do we got to do? Then use AI as a tool to help you solve it. So I think that's where the programs in higher education are probably moving. I'm going to go. But again, it's not the easiest thing to do. You got to come up with good practical examples in the classroom of that sort of stuff. And that requires time and effort on the faculty's part as well.
It's trick. I feel like what I'm thinking through in my mind right now is like something tricky about this situation that we're in is that there's so many quickly moving parts here. I'm thinking two parts. I'm thinking from the part of the view of the firm. So how does the general corporation address this, right? They have the fiduciary responsibility to their shareholders to maximize their investment, and so they need to invest in AI, right? And then how do you do that with avoiding the long-term downside, which is what you described of not having mature talent in 10 years or however long. And then the other thing is that with AI changing and the kind of the university's role in that and preparing talent that's ready to go and enter the job force, but with the landscape changing so quickly, I mean, it's really hard how you build tools today.
Some of what you're seeing, I think, in the corporate world, the drop of the decline in investment that's being reported caused some of the GDP numbers to be lower than people expected. A lot of this is it's due to uncertainty of what the future is going to look like. I mean, the hiring of the spring 25 college grads has not been as robust as previous years. And a lot of it's simply because companies are not sure, what the near-term future is going to look like. What is AI going to look like in 6 months that we might be able to use? And I think it's not surprising that they're pulling back and saying, when you're uncertain, it's like any finance model would tell you, uncertainty optionality is more valuable when there's uncertainty. And not hiring somebody but leaving the possibility we could do it later, that's an option, is always more valuable in the highly uncertain market. And if there's been any word to describe the change in business environment since last spring, it's increase in uncertainty.
That's a really good point. So something you mentioned I wasn't familiar with was I wrote down the decline in GDP numbers. So this is I should be following a little more closely, but I didn't realize that there was which one specifically
Well, I mean,
declined
you
recently
got,
reports.
the GDP numbers for the first half of this year have not been highly robust. The first quarter was actually a negative number, and that, people related to issues associated with the, fear of the upcoming trade and these sort of things. It was, the idea that importing somehow lowers GDP is a complete falsehood that the press doesn't seem to understand, because any import shows up in C or I or G, and then you subtract it out in the famous Y equals C plus I plus G, minus net exports. It gets subtracted out in the net exports because it was already added in to the C or I or G, and you don't want to GDP is stuff produced in the United States. So if you've brought stuff in and you've consumed it or invested it or the government used it, it got captured in those numbers. By definition, you have to subtract it out. So the fact that you were subtracting out a big number of imports that came in the first quarter, that isn't what caused GDP to be low, because it was already in the front end of that formula with either C or I or G. So, but what we're seeing is companies holding off, although they're announcing, as we've been hearing, we're going to do all this future investment because it garners them some goodwill with the administration. Those things aren't necessarily happening right now, so you're not seeing that big boost in private sector investment, that would boost GDP that way. And so, the U.S. numbers they're not. The second quarter came in around, if I remember, around just under 2%. The first quarter was actually a small negative number, so the first half of the year was running at about 1% or so. In most people's forecasts for what's coming in the next year, it becomes a bit of a political issue who you talk to, but the median forecast is for GDP growth to be not going to be higher than probably 2% over the year at the end of the year, which is not terrible for the U.S., but it's not a booming economy at the end of the day.
What's like the long-term average GDP outlook? Is it?
Well, I mean, it's a great question. I mean, there's a simple long-run formula that macroeconomists like to use, is that a country's long-term real growth rate, remember, we're netting away from inflation. When we talk about GDP, it's only the increase in goods, the quantity of goods, so it doesn't involve inflation. That real GDP growth, and that's the number everybody talks about all the time. So when you hear a GDP number, it's not involving anything about prices, it's just pure goods. In the long run, it's going to be labor supply and productivity growth. So how fast is the U.S. labor supply growing? Well, right now, we're actually probably taking some labor supply out of the country. And productivity growth, this is the big question mark, because historically, for over the last 2 decades, it's averaged about 1%. And so if the labor force was growing at about 1% and productivity is 1%, that's about a 2% long-run GDP growth. And that's probably, I would have said, pretty normal expectation for the U.S. But, if with what's going on with immigration and the removal of the people who came in illegally, many of whom are in the labor force, there is a short-term concern here that the labor force might actually be not growing, and that's going to make, unless AI is somehow going to dramatically pump up productivity, which it might at some point, I don't know when. I mean, that's the big question. But if productivity stays at its sort of historic average of around 1% or so a year, it's going to be tough for the U.S. to break 2% unless something goes on the labor supply side, or, as I said, AI does something to dramatically bump up that productivity number.
Yeah, because so this is interesting. I'm thinking, to me, it's really interesting. So we're talking about the two kind of levers here: the productivity being one, and then labor being the other one. So in that bucket, I'm assuming, or within those two buckets, I'm assuming that AI is always going to fall underneath productivity. Or is there any talk about, like, do we need to count like AI agents to be? Do you think that will ever go into the equation for? Well, I mean, it is.
For labor? There's usually 3 inputs that go into a macro production function: technology, capital K, and labor L. In the simple economist's model. I mean, if you just Google the GDP growth model, it will have A for technology, K for capital, L for labor. AI is clearly going to have change the nature of the A, whether it's constant or it's, and can model that productivity factor as being a function of how much investment's going into technology goods. And so there's lots of complex ways of doing it. And I think, we know right now that most of the private corporate investment that's going on, so I think the number I saw the other day was somewhere around 60% of all corporate private investment in the US right now is going into AI stuff, whether you're building data centers or you're using it to build power plants that are going to power these data centers, which is another whole issue that has to be addressed. That's where most of the private sector investment's going right now. And if you've seen it, I'm sure, is on the business news, is have people over-invested in AI, right? I mean, everybody did it because they're like, well, if we don't do it, we're going to fall behind. And so what generally happens is you have a bit of hysteria, and clearly some of the investments you're doing are probably just negative NPV. And so the market had sort of for a while believed this was, AI investment's a good thing. And now I think you're starting to see they're being a little more careful about it, that I don't know, who's going to win this race? And even if they win it, are they going to be able to monetize it? Or is it going to be something that somebody says, I see what you did, I can reproduce a model like that myself? In which case, kind of like the internet. I mean, we think, if you think back to the internet boom in the late 90s, all these companies skyrocketing and then tanking, it's because the benefits of the internet largely got distributed to consumers, right? I could use a search engine for free, basically. I mean, Google said, as long as you let us use your data, we'll let you use this for free. And consumers got the benefit of all this. And all that they had to pay for it was, you can track what I do and use it to figure out what ads you want to put on my site. Not to say Google didn't benefit financially from that, but at the end of the day, there's a lot of the time we see technological innovation, the benefits of them don't always accrue purely to the producers of it, the companies. A lot of it gets distributed to the consumers through forms of competition and price adjustments, and consumers just say, well, I'm not going to pay that price for it. It gets knocked down. And I think there's some growing concern that AI may be that way. It'll be so common, it'll kind of be like the internet. We'll all be able to use it for generally very little to no actual use cost, yet it's expensive to produce, right? You got to build the models, you got to train them, that it requires tons and tons of access to data, tons and tons of energy. So I think the market's probably starting to rethink that, well, maybe all this investment going in cannot have a 15 or 20% annual payoff. And so they're getting more picky on who they think's going to win and who they think's going to lose. And right now, I think it may just be too early to tell. But what it means is you kind of just lower your expectations on average for the whole portfolio. But it's, if this is what makes business, and finance fascinating, is you don't necessarily know up front who the winners and losers are going to be. And sometimes they're not the companies you expect them to be when you started, right? I mean, if you go back and think who the big companies were in the internet and, early on, I mean, AOL and these guys, they completely collapsed. And these little tiny startups that nobody had heard of, Facebook and Google and Amazon, suddenly Amazon, what are you selling books on the, now look at them. So yeah. I think the market does a great job, right? They eventually figure out and they get it right in the sense that the people who win, are able to capture some of those benefits. But I think with AI, it's too early to know. And there's a lot of money being put into the competition. And you've seen this throughout history in the US. Railroads in the 1800s, the car companies in the 1930s, 40s. Even now, to some extent, car companies are still, the electric car thing is another whole form of consolidation and who's going to win that battle. Tesla was the big early lead. It's increasingly less obvious that they may be the winner now, but this is the way the market works. So I think, I'm not worried about it. I just think the hype around AI is, we've seen this before, and it's not unreasonable to believe that the average price of an AI stock was on average too high. There are a couple of them that are worth a lot at the current price, but there's several that are going to turn out to be not good at the current price. And so you either put your money on a horse, if you're going to buy the whole portfolio, you're going to win a few and lose a lot in others. So, take your bumps.
That's it really, I love the comparison there. I have several thoughts, but one is I'm thinking around the electric car comparison, and you were talking about how there were a lot of companies that and how some companies may shake out. And I'm just thinking, I remember a few years ago, I was reading that Ford was ramping up their electric car production significantly, and that was a really big hype. We can't keep up with demand, and then all of a sudden, that's already wound back down.
Yeah, they said, no, we're cutting it. It's not working for us. So.
Yeah.
But in the same time, you got to think that in the longer run, this has got to be the technology that's probably going to win out at some point. I mean, there's been this big resurgence back to fuel, petroleum products in the U.S. And, the U.S. is a little bit more of we like big macho cars with huge engines and things like that. And maybe we're going to continue to hope that that'll be maintainable for some time. But, in 50 or 100 years, I'd be shocked that the majority of cars that we're driving around in are petroleum based. So, there are going to be other countries, and we see it right now, that are been able to move well ahead in terms of producing low cost efficient electric vehicles. I mean, China does it not necessarily in purely market format, but they've been able to do that. And so the question is, how does the rest of the world deal with that? And, right now, we're back in the worlds of, dare I use the T word, tariffs as a way to protect industries, or I don't know, maybe in the U.S. just raise revenue. I'm not 100% sure what the ultimate approach is at the end of the day.
So this, like I call it the T word. I remember, so I read a lot of different things about tariffs, and again, it's been a long time since I've studied this in detail. But something I read recently is that ultimately the consumer, and I guess this makes logical sense, but ultimately the consumers are the one who bear the brunt of tariffs. And I'm just curious if you have just general thoughts, not political thoughts, but just general thoughts on tariffs and I don't know how they're impacting us, and what they're, I guess, keeping with the. I'm going to pause there. Any general thoughts on tariffs and how they actually are impacting us?
Well, I mean, let's think about it in the most abstract way. A tariff is a tax, right? And taxes create distortions, right? I mean, when economists talk about free markets and perfect markets, there's no taxes in those worlds, right? It's a completely, private sector. There is no government to finance. We like to start in that world because we know that you can come to a first best efficient outcome if you allow for people to freely trade and there aren't other market distortions. So it's a little bit of a magical universe that we live in, but it's nice because we know what the first best outcome is.